Warren Buffett recently sold $20 billion worth of his biggest holding, Apple. But more importantly, he's sitting on $150 billion worth of cash, his biggest cash position ever. Buffett never comes out to make big, bold calls on the market, but anyone who has read the guidelines that he follows to invest knows that his massive cash position today shows us that he's about as pessimistic as he can get on the stock market. Warren Buffett has generated an impressive 19.8% annual return since 1965. That means $1 in 1965 would be worth around $42,000 today. But Buffett has never used macroeconomic data or indicators to try and predict what the market is going to do next. He abides by fairly simple principles that go as follows. The more expensive stocks are, the better they've done, the riskier they are, and the less investors should be exposed to them. The less expensive they are, the less risky, and the higher expected return you can expect from them. Now, this may sound too simple to be true, but this is something that absolutely does work. This right here is a chart showing us the 10-year return of the S&P 500 over time. Over the last 100 years, we've seen stock market performance vary anywhere from around 300% over the course of 10 years, like in 1999 and towards the end of the 1950s, and as low as a negative 30% return over the course of 10 years, like here in the 1930s following the Great Depression, or here in 2009 following a deadly combination of the dot-com bubble popping and the financial crisis unfolding. Believe it or not, all of these major turning points that you see here were absolutely predictable. These moments when the S&P 500 posted its lowest return over the course of 10 years came exactly 10 years after the stock market was the most expensive. And these moments when the stock market posted its best returns came exactly 10 years after the market was the cheapest. We can see that by adding an indicator called the Schiller PE ratio. When we shift forward this Schiller PE ratio by 10 years, we see that peaks in valuations coincide with the worst periods of market performance, meaning that high valuations predict low returns. And the opposite is true for the bottoms in valuations that coincide with peaks in performance. This is an indicator developed by a Nobel Prize economist that basically illustrates how expensive the market is. In fact, if we go one step further and flip this chart of valuations, we see that the Schiller PE ratio has basically a perfect relationship with the S&P 500's 10-year return, with an extremely powerful predictive value. By following this simple chart of valuations, Warren Buffett would have been able to avoid huge market losses during the 1970s and huge losses between 2000 and 2009. And he would have been able to allocate huge amounts of capital when the stock market was at these attractive levels and poised to see exceptional returns. And today we see why Warren Buffett has decided to substantially increase his allocation to cash and even sell off shares of one of his favorite stocks. Because with the elevated valuations that we have on the market today, the returns of investors who have a long-term investment horizon are likely to be very low. Now, there are brief moments when the stock market's returns diverge from what valuations are showing. The most obvious example being in 1999, when valuations were predicting that market returns should be rolling over. Instead, the S&P 500 surged for 2 years before finally coming back down to reality. But in general, we should be expecting stock market returns to be relatively low over the next 10 years. On this channel, we use our knowledge of macro, technical analysis, intermarket analysis to try and understand the market's next move, because that's what we're good at. It's what we do for our clients at Game of Trades. It's what we find the most interesting, and it's what you guys find the most helpful. And in the short term on the S&P 500, we've been very vocal about the market placing a significant bottom in April and moving higher. We took our clients step by step through this corrections, selecting the best stocks and sectors to add to a portfolio during this period of volatility, and so far it's been paying off. But making these types of short-term bets requires a great deal of risk management, because sometimes you're going to get calls wrong. That's why for every trade that we have on the website, we know exactly when we want to be out of that trade to limit our losses. By the way, if you want to benefit from these types of calls and education, you can join our membership. You won't regret it. But if you're more like Warren Buffett and you just want to know when stocks are attractive or unattractive from a long-term investment standpoint, well, then the answer today is 25%. A 25% allocation to stocks is what's recommended when the stock market is this expensive in Warren Buffett's holy grail, the intelligent investor. The rest of it, so 75% of your portfolio, should be allocated to cash to generate a stable yield. The idea is that when stocks are as expensive as they are today, the expected return that you can get from the stock market over the long run is going to be lower than the yield that you get from holding cash. Today, the yield that we get for holding cash is at around 5%. When we look at the dividend yield of the S&P 500, it's at around 1.35%, so significantly lower than what you get from holding cash. And when we look at the earnings yield on the S&P 500, it's at around 4%. The earnings yield is basically the return on investment that you can expect from stocks, and it's currently about 1% lower than the yield you get for holding cash. And as you can see from this chart, this hasn't happened since 1999. This chart shows us the spread between the S&P 500 earnings yield and the yield that you get for holding cash. Every one of these moments that you see where this line is below zero is when stocks are less attractive than cash. And these were actually pretty bad moments to be in the market, many of these dates corresponding to significant peaks in the stock market. What you want to be doing as a long-term investor is increasing your allocation to stocks when the earnings yield is substantially higher than the cash yield, which was the case in 2020, 2008, 2003, 1994, 1977, and many times in the 1950s and 60s. Maybe one day we'll get that opportunity once again. What's 100% sure is that we'll be covering it at gameoftrades.net.